If most of your estate is tied up in property, your family could be forced into a rushed, undervalue sale just to pay the tax bill. Here's exactly how that happens and how one family avoided it. Say your estate is worth 2.4 million, most of that in property. On paper, that looks like real security for your family, but when you die, none of that value is cash, and HMRC doesn't accept property as payment. They want the money usually within six months of death. If your estate doesn't have enough cash sitting there to cover the bill, your executor is left with two options: find the money fast or sell your property fast. And a fast sale rarely gets a fair price. I dealt exactly with this type of situation for a client's estate, which was worth around 2.4 million, had almost no cash, large inheritance tax bill due, and a property that needed to be sold properly, not rushed. HMRC starts charging interest on inheritance tax 6 months after death, whether or not probate is finished. But selling a property properly, getting it valued, marketed, and negotiated to a fair price takes months, often longer than HMRC is willing to wait. That gap is where families lose money, not through bad luck, through timing. Once an executor is under pressure to raise cash quickly, their decisions start to change. A normal marketing period suddenly feels too slow. Negotiating on price starts to feel risky. A low offer starts to look acceptable, simply because it's quick. That is what nearly happened here. Instead, we worked out exactly how much cash was needed to cover the tax bill and exactly how much the estate could actually access. That gap was the real problem, not the property. We arranged short-term funding to cover it, nothing complicated, just enough breathing room for the property to be sold the right way on the open market at a proper price. Months later, it sold, not at a discount, but close to full value. And that one decision preserved around 140k for the family. And that is before counting the extra interest HMRC would have charged if the tax bill had simply been left. Here's the part that matters for you. This is completely avoidable. It only becomes a crisis when nobody has worked it out while you're still alive. The families who never end up in this position are the ones who know in advance roughly how much inheritance tax their estate will owe and exactly where the cash to pay it will come from. Sometimes that means changing how assets are held. Sometimes it means putting specific cover in place to fund the tax bill itself. It's often simpler than people expect, but only if someone works it out before the clock starts running. If you're not sure whether your own estate has that gap, that is the first thing worth finding out, not after you're gone, now, while there's still time to fix it. I put a free inheritance tax diagnostic in the description. It takes a few minutes and shows you where your own estate stands.